Hey, I'm Devin from Visions, and on this episode of Cash Clips, we're talking home equity loans. To get a home equity loan, you need a home and you need equity. Now, equity is the difference between what you owe on your home and how much it's worth. So, for example, let's say that you have a $100,000 home and you have a $70,000 mortgage on it. That difference, that $30,000, that's equity that you've built into your home either through down payments or just making your normal monthly payments. Now, a home equity loan allows you to use that equity you've earned to get the money you need for what you want. There are two types of home equity loans. There's your traditional fixed rate, and then there's your home equity line of credit. Most people just call it a HELOC. Now, the difference is how you use them and how you take that money out. With a fixed rate home equity, it's kind of like a traditional loan, like your mortgage or an auto loan. You take all the money out up front that you need for whatever it is that you want to spend it on, and then your payments are tied to that fixed loan amount. Now, a HELOC, it's kind of like using your home like a credit card. You advance what you need when you need it for what you need, and then you make your payments based on that. There are two great benefits to a home equity loan. First things first, the rate. Because it's secured by your home and based on the equity that you've put into it, it tends to be a lot lower than, say, a personal loan or even a credit card. And the other thing, you can use it for pretty much whatever you want. Big ones are home improvements, putting in a pool, consolidating debt, student loans, maybe even putting solar panels in on your house or preparing for a big wedding expense. A big question with a home equity loan is how much can I borrow? And it all comes down to that one word, equity. Because the fact is, if you don't have any equity built up in your home, you don't have anything to borrow off of. So most people take out a home equity loan once they've been established in their home for a while. You know, they've made their payments, their balance on their mortgage is getting lower, so they have the available funds to borrow off of. Next up, it's simply the type of program that you have. So fixed rate home equity may allow you to borrow less than a HELOC. Could be the other way around. It depends on your financial institution. So check with them as you explore your options. To get started with a home equity, you'll need two things. You'll need your deed, and you'll need your financial institution. And that's really important because they're going to really help you through the next steps. They'll schedule an appraisal to determine the value of your home. That will help you figure out how much equity you have, how much you can borrow, and what programs you qualify for. And when you're talking about programs, ask them about promotions. They might even waive closing costs if you take out a loan for a certain amount. There might even be, say, 0% interest for a year on a new HELOC. Ask what's available. They're there to help. Hope you learned something about home equity loans today. I'm Devin from Visions with this episode of Cash Clips. Hope you enjoyed the video. If you did, like and subscribe. We got a lot more great content out there, and I'll see you soon.